All right. Good morning, everyone. Welcome back to another episode of the Tim and Tim Show. Every Tuesday at 10 a.m. Eastern Time, like clockwork, we're here every week talking about controversial topics, talking about informational topics, talking about experiences, talking about just about everything that we're learning and experiencing through multifamily operations on a day-to-day basis. And May 2026, this is our 5-year anniversary of having the Making Moves in Multifamily Facebook group. And
Five
we've been
years?
5
Wow.
years now. Yeah, I think Tim, we probably hit our 10,000 hours.
Are we experts?
I think so. I think we can
Okay,
I
cool.
think we can claim the expert box now because we're 10,000 hours in. I think they say generally it takes about 5 years to get to your 10,000 hours. So we have been doing this for 5 years now, and we therefore are experts.
There you
And
go.
that's a wrap. No. We
Can
made
we
it.
can we
On to the next asset class.
so we're moving to a subscription fee, right? Like
Yeah. You can sign up on my Patreon account.
there you go.
Uh, all right. This week we're talking about something that's a little bit more controversial, and we're going to kind of address the elephant in the room, and that is managing LP expectations in 2026.
Ooh.
We have had a ton of conversations with LPs, absolute ton. I've had a lot of conversations with our mentors. I've had a lot of conversations with other people that operate in this space, and a lot of people that used to operate in this space and do no longer. It has been a wild, bumpy ride the last couple of years. Uh, we have learned a lot. We have experienced a lot. I There's got to be a few more holes in the walls of my house because of this industry over the last couple of years. But all in all, we're here today, and one of the most difficult things that we're dealing with right now is managing LP expectations. Because when we acquired properties 2, 3 years ago, even up to 5 years ago, the real estate market looked different, right? The
Yeah.
underwriting expectations looked different. The debt assumptions looked different. The cap rates looked different. Buyer seller mentality has changed. I can tell you literally firsthand. Tim and I have a deal on our table right now that we know we can get it for a pretty decent price, but we don't want it. And you know why? Because it doesn't solve for the number one thing everyone is trying to solve for, which is cash flow.
Cash flow.
There's there's a ton of equity. There's a huge equity play on this deal, and it can make somebody a lot of money. But I don't feel comfortable buying a deal that is uh, reliant is a good word, reliant on making sure that the market stays high, right? Because
Yeah.
you have any fluctuations in your expenses or your income, and you're having a bad time really quickly, right? And I think that is one of the things that we need to talk about with addressing LP expectations is the deal that we bought a couple of years ago is not the same deal that it looks like today.
Right.
And we have pivoted. We have done what was necessary in order to make sure that the deals are successful in today's light, right? Successful in today's right. And having those conversations can be very difficult, but we're going to talk about some ways that we have successfully done it and some of the pushback that we get from investors and from other operators and just generally the sentiment and the sentiment and how we're handling those types of situations because everyone likes to say that saying is choose your hard, right? And is it, this is one of those times you have to choose your hard. Do you kick the can down the road or do you get
Yeah.
right out in front of it and then you just address the elephant in the room?
Yeah. And one of the elephants that I want to address right off the bat, man, is, and I think this will take 30 seconds, is the idea that, if you're not hitting your projections, you didn't test it enough. And here's the thing I would say is I don't disagree that you need to stress test a deal. I think that's just common sense, right? But the idea that you can stress test it fully for every scenario, every whatever, I think is just crazy, right?
It's
Like
unrealistic.
it's unrealistic. You can't every lever on that underwriting file has 100 different options, right? So, I mean, you think about that. You got 20 fields that you're underwriting to, and each one has 15 options available to it. I mean, you just can't possibly stress test every one of those scenarios. And because, one of the things that we've gotten a lot of pushback on, and they're like, "Oh, you didn't stress test it enough." I'm like, "Yeah, I did." But what I didn't stress test was, the 30-year freeze that we had in North Carolina that, busted the sprinkler system in the breezeways that, really set us back for this particular quarter. No, I'm sorry, I didn't stress that. Stress test that, right? So, I just want to kind of throw that out there because, a lot of times what you get is if you're not hitting expectations, you didn't stress test it or you didn't underwrite appropriately. And I just disagree with that.
I agree too. I mean, because no one stress tests for a specific event. They
Right,
stress test for averages over the course of a year.
right.
And I think that LPs like to focus in on a singular event in a singular quarter and
Yeah,
say, well, you didn't do this on this quarter and therefore you're a failure. And that's
yeah,
not true, right? It's impossible to say what could go wrong on a property over a 5 to 10 year lifespan. I mean, some of the some of the things that come across our desk as emergency maintenance is like, what? Well, like, one of my favorite sayings is, "This wasn't on my bingo card for this month."
right, right, right.
Um, but yeah, so I mean, it's difficult, right? Because, obviously everybody invests into real estate because you want the benefits of real estate investing, right? Oh, how about ice rolling up to your properties? Oh, man, that one was a good. I
I
mean, that
I'm
really
wondering
affected our construction crews.
I'm wondering if I know who that is.
I think we do know who it is. Yeah, nobody anticipated that, right? And nobody anticipated that to happen. Our construction guys wouldn't leave. Like, they were like, "Nope, I'm not going anywhere for 4
Yeah.
months." So
So
we took on vacancy during that time because we couldn't get the units turned.
yeah, so we had that issue. I know another operator, and I think that may be who this is. I know another operator who had ice roll up on their properties. Um, did a did a sweep, took a bunch of residents away, and then even the residents that weren't taken were scared and left.
Yep.
So he not only did he lose a lot of tenants from ice, he had like a huge number of skips like over the next couple of days. And you all of a sudden you end up and you're like, holy shit, my 95% occupied property is now at 60%. This is crazy. It's
Right.
like, yeah.
Yeah, one
So
one of the conversations I had with an LP, it wasn't around that conversation specifically, but it was more along the lines of, "Well, didn't you guys bring the property management in house? So you should be able to better control your cash flow and occupancy." It's like, well, I can't really hold a gun to people's head to make them pay the rent. I mean, yes, we can give them late fees, we can give them notices, we can do everything that we can under tenant landlord laws
right.
entice them to pay, but we can't make them actually go on and pay, right? I mean, why do you think repo men have a job? It's because people stop paying their car note, right?
Yeah.
Um, and the other thing I can't do is I can't control people skipping. You
Right.
just can't. I mean, and it's a wild thing. I've really never even knew that that was a thing until I got into real estate investing in the apartment space. Was that people will just up and leave and not
Yeah.
say anything, and they leave everything behind and they don't pay the rent, they don't give you
Right.
notice. The only way that you find out is because you do a wellness check on them like, "Hey, we haven't heard from you and your rent hasn't been paid. We haven't seen your car. Are you okay?" And
Yeah.
they'll leave at nighttime or over the weekend when nobody's there and you're none the wiser.
Yeah. Yeah. It's yeah, I like that. I like that idea, right? That because you own the property management company, you should have, I don't know,
Better
some
control.
better control. And I guess what I would say to that is, yeah, to some extent, I'll agree with you because that means what I would say is I have better control over the tools that I utilize, right? Because right, we've had proper third party property management where we're like, well, we want you to do this, and they're like, well, that's not how we do it, right? And or something like that. So maybe I'll agree with you on that point, but to your point, like all I have is tools. I can't control how the people react to those tools, right? Um, I
Right.
that I can't control at all. I like I'm going to evict you if you don't pay. Okay.
All right, do it. I mean, hey, I was a
Yep.
renter in a pretty nasty situation with a landlord that was just nasty. And
Oh,
I just stopped paying for 9 months, you know? I did end up paying the bill because I didn't want a judgment on my record, but, a lot of people just don't care about that. But obviously,
yeah.
being in the real estate world, I can't have a judgment on my track record.
Yeah. Yeah. Hey, man, I didn't even think about the maintenance teams, but yeah, it's kind of like our turn teams and our reno teams, right? Like same thing.
Yeah.
They didn't bolt, but they would not leave their homes.
Yeah.
So yeah, kind of. Yeah, I hear you. I don't have 12,000 tenants. I don't think. Maybe I do. Do we? We do. Yeah, we do.
12,000?
No, no, no. We have 14. No, we have more like 1,500 tenants. Yeah.
Yeah, right, right.
Yeah.
Combinations of like twos and threes and all that good stuff. But
Yeah.
yeah. So, one of the other things that we face quite often is in conversation with LPs and managing those expectations is they always bring back to how much money they made during COVID.
Yeah.
Debt was cheap, transactions were happening. I mean, banks were literally throwing money at people to buy property. Like they couldn't deploy money fast enough. And that led to property values increasing significantly, sometimes even overnight.
Yeah.
And the LPs that were part of that ride loved it. Everyone loved it, right? And of course, I want those days to come back too. But let's be honest, they're probably not going to come back unless we have some COVID version 2 that shuts the world down and they drop interest rates to 0 in order to, spur spending so that the economy doesn't shut down entirely, right? So, I mean, we could go on and on and on and on about that, but there's been a lot of education on our side to LPs that we're not in 2020 or 2021, 22
Right.
anymore.
Right.
Last week we talked about how Charlotte in 2024 broke a record for how many units they delivered. And there was such an oversupply of units all at the same time. The next quarter, Charlotte also set another record with the amount of absorption of those units over a short period of time. We're seeing where supply and demand affects rent rates, and it affects like our leasing ability and our lead flow and interest, and all of that type of stuff. So those types of things are not happening anymore because 2024 happened. We had a decline in the rents, we had a decline in property values. What year was it when they started doing those 75 basis point increases at the Fed? Was that
I feel
2023?
like it was late 23.
Yeah, like June, July, August 2023 is when they started doing those like 75 basis point rate increases every 6 weeks, right? And that just like absolutely put a huge halt and a damper on property transactions everywhere, right? So those are some of the reasons why we're not getting those types of returns anymore.
Right. Yeah. And, and the interesting thing, it's always like this chicken and the egg conversation, right? It's like,
Always.
did, did the market shape unrealistic LP expectations, or did the market shape unrealistic operator expectations? And then operators went out and
Ooh, yeah.
pitched those expectations onto LPs. Because, what's interesting, Tim, like if you think about it, we keep talking about like sophisticated operators, sophisticated investors and stuff. It's like that. It's like you don't tend to get a lot of those complaints or questions right now from those guys. It's like the operators or the investors who kind of got in during that window, right? But you get the seasoned guys that walk in and they're like, yeah, I'm not asking questions really right now about the why I'm not getting a distribution or whatever, because they'll come in and go, hey, what's our reserves look like?
Mm,
Right? Like, how do our
yes.
reserves look? How are you handling? What are you doing to mitigate these insurance costs? Those are the kind of questions we get. I don't really get a lot of like, where's my distribution questions from that guy, right?
I think it's fair to say maybe 18 months to 2 years ago when we had to stop a lot of the distributions because of the change in the insurance costs. And
Yeah, yeah,
we started to see a lot of expenses and income change, and we paused distributions because we're like, wait a second,
right.
we don't really feel comfortable with the projection of where this is going, so let's pause distribution. We had a lot of conversation around distributions then, right?
Yeah,
Naturally, because you were getting distributions, now you're not, so people are going to ask, right? But
of
we as
course.
the operators had to make a conscious decision of, are we trying to maximize distributions and keep investors happy? Or are we trying to preserve our liquidity and make sure that
Yeah,
anything that does come up, we have the cash to weather the storm? And one of those storms that a lot of people didn't put enough emphasis on is when those insurance policies came due and they doubled in rate. and you had to pay that money up front, where do you think that money came from? Either the reserve account, or they did a capital call, or the sponsors put up the money to pay for the insurance.
Yeah. Yeah, because and Tim, you're not wrong. Like I always find the question interesting, right? Because even thinking back to that as you're talking through it, I'm thinking back and I'm like, it was always interesting. It was like we would it tend to come from two fields, right? Like there was the investor who's like, where's my distribution? Right? Like because they literally wanted that $75 or $250 or $1,000 or whatever. And then there's the guy who would show up and go, where's my distribution? And the reason I'm asking is because historically, when distributions stop, it means the deal's in trouble. So
Yes.
I'm worried about the health of the deal, right?
Hmm.
And guys, like hopefully you can kind of see the difference in that question, right? Like one person's worried about like, why didn't I get some cash this quarter? The other person's like, hey, the cash is just a sign to me that this deal may be struggling, right? So I want to talk about that. And
Yeah.
and I don't disagree. I don't disagree with that sentiment, right? Because it can be one of the first signs that something's going on, right? Um, you were going to say something. Well,
Oh, I was just saying that, that's what sophisticated LPs are looking for, right?
yeah,
Is they're seeing those, I don't want to call them red flags, but indicators to ask a question.
right,
And those questions are warranted and welcomed, I would say,
right,
right? It's
right,
it's when you get the people that are complaining that they didn't get their $75 quarterly distribution, that you're like, guys, like that, what? This doesn't even fill up your gas tank. Like,
right.
I understand like the principle behind getting distributions is important because you need cash flow, but at the same time, I think that cash flow overshadowed asset preservation or
Uh,
well, no, equity. Sorry, I was trying to think of a word. Equity preservation was obviously it's such a bigger conversation than
yeah,
how much money am I going to get. I mean, if you look at everybody likes to quote Warren Buffett's rules number 1 and 2 is rule number 1, don't lose money. Rule number 2, see new rule number
reward,
1.
reward, right,
It's like okay, well that is it in real time in
right.
effect. And now that you're seeing it, you like to say it and you like to feel how it makes you feel when you say it, but when you're experiencing it, you don't respect it.
Yeah. Yeah. And guys, like part of the reason when Tim and I are talking about this is, this has been going on for a while. We had a conversation recently, right, on a deal that, for multiple reasons outside of our control is, that is not going to hit projections at the refi. And where I was going with that, Tim, where I'm going with that, Tim, is like you're talking about like preserving liquidity, preserving the deal versus, yeah, versus maximizing cash flow or giving something to the investors. How many conversations have you been in where it's like, oh, we can't, the deal's okay, liquidity is a little bit lower than it should be. What do you think about distributions? And somebody will say, well, let's just give them something. And it's like, but even $100 per investor takes away from the liquidity, right? And it's like, so is the idea here to make the investors feel good because we put something in their bank account this month, or is the idea here to fully ensure that we are protecting the deal and protecting their investment as a whole, right? Because I get the idea. I get the point of, hey, they see something come in and they feel good. Well, I'm not necessarily concerned with making them feel good through a cash distribution. I want them to feel good knowing that we're doing everything we can to preserve their investment as a whole, right?
Yeah.
And
I think a lot of all of that comes back to the communication and the
that's where I was
transparency.
going. Yep,
Exactly. Yeah.
100%.
I felt it. We're vibing. We're vibing. I feel
We
it.
got it. We're on this.
I mean, God, man, we do monthly calls with our
Yeah,
GP teams, right? Because we are the main sponsors and GPs in all of the deals that we do. We also own the property management company, right? And we send out the financials and we do it. But we do a monthly call and we invite all the GPs on the deals to come and ask questions, to
right,
dissect the financials, to talk about projections or like what do we think is going to happen, what are some hurdles and roadblocks that we're experiencing. um, I would have to say that we do cover all of that in our quarterly updates to our investors. We spend a
right,
lot of time doing our quarterly updates to our investors,
right.
and that is always our number one guiding light is honesty and transparency, right? Through communication. And are we the best at it? No.
No.
but we're always trying to improve, right? And we're always trying to get in front of a situation and say, well, this is what's happening. This is what we learned from it. And this is how we're preventing it from happening again. Or, hey guys, we see this hurdle upcoming, 6 months from now. We're aware of it. And this is what we're already doing to work around it.
Yeah.
So maybe part of the reason why we don't get so many questions from LPs as maybe other people do is because we address those elephants in the room. And that's one of my favorite sections of all the quarterly updates that we do is like upcoming hurdles. Like what do we know is upcoming? Every quarter it's going to be something, whether it's a insurance renewal or if
Right.
it's a property tax bill that's coming up or if we have a leasing season with a high exposure to expiring leases, right, where we're sending out renewals, we could potentially have a lot of vacancy coming up over the next quarter just because of the timing of these renewals. And we
Right.
can't guarantee people stay, right? And we offer the renewal and it's just part of the business. But that when you address it up front and you're like, hey, we're aware that this could happen and this is what we think could happen. Perfect example is one property we own we had like 12% vacancy coming up because of, we had received non-renewals. People were just moving, they were upgrading their lives or moving to bigger units or whatever they were doing. We're like, hey, we know we're going to have 12 vacant units coming online over the next quarter. Here's what we're doing. Here's how we're preventing it. And here's when we think we'll be through this turmoil. And we
Right.
nailed it. I mean, we did. And we had no questions from anybody. And it was reflected in the financials correctly with a dip in the income, a dip in the NOI, and now we're well into Q2, and we're back to where we were in Q4.
Yeah. Yeah. And Tim, that's a really good point because, guys, it really does all come down to that communication, right? And you mentioned that we have a lot of GPs that work with us. And one of the things that Tim and I always try to work with our co-GPs and help them understand is like, hey, listen, I'm here to help you answer questions, right? I'm not here to communicate with your investor directly because here's the thing, like I am an investor, right? I have some LP deals. I don't want to hear from Tim and Tim when I didn't invest with Tim and Tim. I invested with somebody who brought me into Tim and Tim's deal, right? So I want to see that that person who I invested with is actively engaged and actively connected to the deal. So I'm kind of like, listen, I know how I feel as an LP. So my suggestion is like, come to us, ask us questions, but you really need to be that kind of like face and point of contact to your investor because they trusted you. And,
Hmm.
you know, and by the way, I'm like, you have that relationship. I think you understand how you need to craft those words back to the investor. Because I got to be honest with you, I'm going to talk how I talk and your that relationship wasn't formed that way, they may not appreciate it. Right. So
I think some people connect us directly to their LPs because they're trying to preserve their own face to their
uh,
LPs, right? Because they're
I don't
pushing the
disagree.
blame.
Yeah, I don't disagree with you at all.
Yeah, that's what I think is happening. Is that well, it's not my fault. These are the guys that are operating it. Like, hear it from them, hear it from the horse's mouth directly, because they're the ones that are in charge of the deal.
Yeah, which I guess that's a point. I guess that's a point. But man, those deals that I'm invested in, where it's like that, somebody brought me into that deal. I'm like, but I'm not looking at them. Like, right? You brought me into this. Like, what are you
Mhm.
doing over here? You're a GP. What are you doing to connect to this?
Oh, nothing, by the way. I just don't want to tell you nothing, but I'm
Yeah,
sure you can assume it.
yeah. So with that in mind, man, like all these things are going on. Cash flows, stressed because of debt and insurance and taxes and all this other stuff. Like, what are LPs looking for now? I think I know what I'm looking for as an LP. What do you?
Cash flow, right?
Yeah,
I mean,
yeah,
that's why I started out the show talking about a deal that fell on our plate. Like, 5 years ago, it would have met our investor expectations of doubling your money in 5 years.
yeah,
It would have been great, but there's no cash. I mean, the cash flow was like 4 or 5%, and
yeah.
that's if everything went perfectly. And it's just not enough. Like, people are like, well, if I'm only getting 5% cash flow, why don't I just stick it in a CD?
CD. Yeah,
And it's like, well, there's a big equity play here. And a lot of this, I'm not going to lie here, a lot of the sentiment has been, well, I invested in a lot of deals that were supposed to have big equity payouts on the end, and none of them are happening now. And it's like,
yeah,
that's a fair conversation too. But what you can't argue is that when you're buying a property, the rent roll is what the rent roll is day one. And
yeah,
if you model your debt off your in place rent roll and your cash flow that follows, there's really no argument there for, why it should change substantially. Because as an operator, you'd still want there to be some level of a value add where you can continue to increase that
Yeah.
cash flow. And as you increase that cash flow, that offsets any changes in the unforeseen expenses that come up, right?
Yeah.
I mean, there has to be substantial cash flow. And I think we haven't raised money in 2 years. September will be 2 years since we bought a deal.
Right.
And I think that the conversations when we do get something under contract now is we're not shooting for doubling your money in 5 years. We're shooting for 7, 8% consistent cash flow over 5 to 7 years. And on the backside, there may or may not be some additional equity, but we're investing for the cash flow now and the depreciation now. And if there's equity later, fantastic.
Yeah. Yeah. Which is, and a lot of folks kind of look at us, and this is a great transition. A lot of folks look at us and they're like, "Are you not doing deals anymore?" No, we're doing deals. We're doing deals, but we're being very disciplined. We're having much different ideas in terms of long-term thinking, and I think that's huge in this cycle.
Mm,
And then
yeah.
while we're doing that, guys, we're honing in our operations. We're using the time to make ourselves better operators and better able to scale when those things do come on our plate, right?
Yeah.
Um,
And shout out to our team. Our weekly scorecard came out on Friday, and our portfolio average occupancy is 96.7% across the entire portfolio.
You know what's funny, man? Like you pay attention to operations and they improve. Like
Yeah.
it's kind of crazy. And what's funny, guys, is like we can look back across that scorecard that Tim's talking about. It's like, hey, when we have taken the time to go and look at this, and we're not doing 14 deals, right? We can see this. We can see this
Hmm.
happening, right?
Yep. Yep.
Um, so
Which feels good, obviously.
yeah,
Man, I'm ready to
I want
onboard
a
a new
deal.
property in a bad bet in a bad. I'm ready to onboard a new one in a bad
Come on,
way.
man. Come on.
Come on, come on! I need some juice. Oh, Suzanne has a good question here. She says, I'm always asking what levers can you control as an operator? Focusing on traditional methods only will produce traditional results in a time and place that requires some further ingenuity. What are seeing with operators that are succeeding? Are they doing anything different than they have been before? Hmm. Are they doing anything different than they have been before? I think that comes back to Tim, what you were saying was, did 2020 to 2022 shape expectations of operators and how it's being communicated to LPs, or
Yeah,
did LPs' expectations just change? And it is a bit of a chicken and the egg thing. And I think that what we're seeing is the people that are happy in their real estate investments are the ones that have the expectations of
yeah,
conservatism, right?
yeah,
It's the lower cash flow, it's the lower IRR, it's the safer long-term debt positions. It's the operators that have been doing it for many years now and have a track record of operating deals successfully. They feel safe and secure that the person that they invested into is doing right by their deal. And a
yeah,
lot of the frenzy of value add and kind of the the buzzword of, oh, it's a value add deal, it's a value add deal, like that's gone away. Because it's somebody, we had a conversation last week with a broker and he's like, well, this has got a lot of value add. I'm like, I don't care. I want to know how much cash flow it's making today so that at the end of Q1, we can make some distributions consistently to our investors. And it doesn't have to be 7% year one, but it's got to be at least,
yeah.
3, 4, 5% year one with a path to increasing to 7, 8, 9, 10% over the next five years.
Yeah, and Susan, I think one, or Suzanne, sorry, I think one of the things you are seeing today that kind of got lost in that 2020 to 2022 frenzy is tenant quality and sense of community on the properties, right? Because I think one of the things that got lost is people are like, I'm going in and I can get 150, 200, 3, $400 increase on rent. I don't give a crap what kind of tenant that is. If they don't want to take my increase, they're gone. I don't care if they pay it on time. I don't care if their apartment hasn't been touched in 10 years. And as soon as they go, I got to drop 10 grand just to get that apartment to where it needs to be so I can get that $300 increase. And then, oh, yeah, I'm going to take on, 20% vacancy to do it. And that means I'm going to have to lease up, which means my tenant quality coming in the door might suffer. Right. So I'm going to go from a highly stabilized, consistently paying, low delinquency property to I'm not sure what I'm going to because I just changed out 50% of my tenant base, right?
Hmm.
I think you're seeing people not do that as much now. they're
Yeah.
looking at it and going, don't create a situation where I'm taking on a $5,000 or $6,000 expense to try to get a 75 to $100 rent increase. Can I get a $50, keep that good paying tenant and not drop the 5 grand in capex? You're starting to see that more. And then you're also seeing it where people are like, hey, the quality of the tenant matters more than a $50 increase, right?
Mhm.
So because I think it was Mark Schuler. I think Mark Schuler had a really good post the other day talking about how the wrong tenant is more expensive than
Ooh.
vacancy. Yeah,
Ooh.
right.
Yeah.
And he's spot on, guys. Like putting the wrong person in there who 3 months into their lease doesn't pay is more expensive than if you had just taken on 3 months of vacancy looking for a better quality tenant.
Mhm.
And I think you're starting to see more and more of that, right? Like that's a lever that you can control as an operator. For the most part, you can't control how the county assesses your taxes. You can't control how the insurance company looks at your deal. I mean, there's
Can't
some things
control
you
the
can,
utility usage rates.
right? Yeah, like you can't. There's some things you can do to mitigate those things, but you can't control them, right?
Yeah, that area
What
is
you can what you can control is your tenant, the sense of community that you build, and how you treat good quality tenants, right?
Mhm. Yeah, he said the key to all of this is occupancy and quality of tenant. Right now, many tenants
Yep.
are stressed financially and are shopping for concessions.
Yep.
Scanning for these types of tenants will save 6 to 8 months of lost revenue and the cost of additional unit turns. Yeah, I mean, everyone focuses on your top line number, top line number, top line number, but I think a lot of people lose sight of how much money you're losing through the bottom line
Right.
in vacancy, turn cost, uncollected rent, leasing commissions, advertising costs, unit turn expense, like everything that goes into finding a new tenant is so much more difficult and taxing on the team than
Yeah.
just giving a 3 to 5% renewal and working those rents up over time. And I can say that some of the properties that we're looking at now that we're trying to buy with 5 year debt right out of the gate is instead of there might be a 20% spread between market rate rents today and where the rent roll is today. But instead of increasing rents 3% year over year, maybe we're underwriting to increasing them 5 or 6% year over year, right?
Yeah.
Because
Yeah.
our target is to get to that as fast as possible without taking on additional vacancy and unit turns.
Yeah. And Suzanne, no problem on the question. Get to it in 1 second. Because one thing I did want to say is, like, guys, that's another reason. Tim, you mentioned something there. One of the reasons you really, really have to watch, like, if you're doing third party property management, watch how that third party property manager is compensated, right? Like, because that property management fee as a percent of the top line may not be where they maximize their profits as a property management company, right?
Hmm.
Because you mentioned leasing commissions. Leasing commissions can be way more profitable to the company than that fee, right?
Hmm.
And if they're taking leasing commissions and giving, like 25% to the actual property manager, but then booking some of that to the company, that's that churn that you don't want as an operator is highly beneficial to the property management company. So look at those things, right? Like dial into those things with your third party property manager. Don't just ask about their PM fee, ask about where they're making money. Like, hey, where do you guys make money as a property management company? Because where you make money may not align to where I need to
Hmm.
look for efficiencies as an operator.
Yeah.
Um,
Yeah,
so
because you might want to structure it so that the leasing commissions more highly incentivize renewals than new leases.
oh yeah, 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 or that they're very similar. Like, hey, your
Oh, that's a
renewal.
good perspective. That didn't even, wow, bing, light bulb, right? It's like,
Yeah,
why are you going to push for this new, this new lease? It's the same. It's so much easier just to issue them a renewal, isn't it?
right,
Yeah. Well, yeah,
right,
it is.
yeah, and then the AI tech stack. Yes,
Yeah.
I, we're we're finding it very beneficial. But there is some noise, right? Like Tim, would you agree? I think the noise there's some noise in the implementation that
Yes.
can cause churn, can cause some chaos. But as a whole, I am finding it as a benefit to the operations.
I would say 90 to 95% of it's a benefit, and the
Yeah.
5% is noise because it's change and people don't like change. But we literally heard it yesterday was, hey guys, great job with this. I'm getting consistent follow-up, I'm getting consistent messaging, I'm getting consistent text messages. The information that they're telling me is correct, and it's removing a lot of the human error on admin type stuff,
Yeah.
which is really good to make sure that your message and your policies and procedures and everything are communicated the same across your entire portfolio, entire community, right? Everybody's getting the same message, because that creates its own little inner problem with inside your community. Is like, well, you told A2 that they could have a pet with no deposit. It's like, well, no,
Yeah.
that's not our policy. Well, then why did you tell her that? I mean, it's just,
Yeah.
you have to deal with that kind of stuff. And the AI, I have to say, removes a lot of that inconsistency in messaging.
Yeah. And really, really dial into that. When I'm highly on board with the AI implementation, guys, but really kind of dial into it, because Tim, one of the things that we learned in the recent AI conference that we attended is sometimes you want to set very clear guardrails for your AI. Sometimes you don't. And you need
Yeah.
to think about those situations, right? Because, if you set guardrails, it's always going to be very black and white. If you don't set guardrails, there may be certain situations where you want it to have some flexibility, because you want it to learn through that flexibility. And sometimes when you don't put those guardrails in place, it causes a little bit of chaos up front, like, sending out late payment fees or late whatever fees when they're not
Oh,
actually legit,
gosh,
right?
that is something that is,
Yeah,
I still don't know how to completely navigate that whole situation, which is why I
right,
haven't responded yet. But it's like, yeah, like sometimes it can be a little difficult, because it's a
right,
little binary, right? It's a 1 and a 0.
right,
Today's the 6th. Did you pay your rent? Yes or no?
right.
I mean, it's a very easy logic. It can't say, yes, I did, but the manager wasn't there, so it wasn't applied. How would I know that? So then this late fee doesn't go out, and this tenant
Yeah,
renewal and this notification, and everyone's upset. It's like, I don't know how to solve that problem except for pay your rent online.
yeah. Because Suzanne, one of the reasons we're a little bit different than like a traditional third party property management company is that our property management company has standards, but at the same time we operate some very different assets, and we need to kind of pivot and change a little bit based on the asset itself, right? Like Tim's talking about, like, hey, we have properties that have tenants that have no problem paying by the 5th, and they're staffed 6 days a week, right? Whatever. So those rents come in by the 5th, pretty much on cue. We have other properties where they're only staffed 2 days a week. Sometimes that
The
the
way the days
staff's
fall. Yeah.
the way the days fall, the first time they're there for the month is on the 6th, and those checks are sitting in the box and they haven't been scanned in, right?
Right.
So
Yeah, that is going to be a difficult one. I think at the end of the day, it's like, right, you just got to push everybody to pay online.
yeah,
This removes this problem.
that would, yeah,
I mean, we have the pay slips, right? So like, here's a pay
yeah,
slip. Go to this
right,
pay slip. It will apply your rent when you pay it, right?
yep, yeah.
I'm
So
sorry. Like, these are your options.
yeah. But
So,
yeah, no, and Suzanne, thanks for the questions. I like the interactive nature.
yeah, that's why we
of,
use StreamYard instead of like a traditional podcast setup,
yeah.
is because we like the interaction, between people and questions and stuff. So,
And LinkedIn user, I'm pretty sure that's you, Mark. So appreciate the feedback, man. I always appreciate your
yeah.
insights on stuff.
So, all right, guys. Well, thanks again. Appreciate it. I hope you learned something today, and we will see you next week, Tuesday, 10 a.m. Eastern time. Peace.
See you guys.